Today we're going to be discussing how the one-tick market surveillance solution delivers continuous examination of order flow, order-by-order replay, case management, high performance, and low TCO. My name is Hugh Heinzen, and I'll be your host, and I'm joined today by Dermot Harris. Dermot is the product manager for the one-tick market surveillance solution that you're going to see today. He joined OMD, One Market Data, quite recently and brings over 20 years of experience with him from former positions at D.E. Shaw, Morgan Stanley in the U.S. and in Japan, and at Goldman Sachs. He has a high level of expertise in technology management, derivatives risk management, statistical arbitrage, futures trading, program trading, and wholesale execution services. As a strategist and trader at Goldman Sachs, Dermot was responsible for the quantitative trading group's high-frequency market-making platform and later for the development of the first fully automated blind bid principal risk pricing workflow. And a few words about one-tick, and then we're going to dive right into the presentation and demonstration. One Market Data delivers comprehensive data management systems to industry leaders, and some of them are displayed here. It's not a complete list, but it's a list of some of our clients. Industry leaders that span all asset classes and facets of finance. We focus on delivering high-quality solutions that are cost-effective and easy to use, empowering users to build queries and analyze data efficiently. And you're going to see some of that today in Dermot's demo. We have a comprehensive suite of enterprise-wide tick data capture, storage, and analysis solutions, as well as reference and closing pricing data solutions that address financial institutions' need to capture, archive, and retrieve tick data, as well as to perform analytics on streaming, real-time, or archived data. So with that, I'm going to turn this over to Dermot.
Hello, everyone, and thanks, Hugh, for the introduction. I see from the guest list that we have a few people who are experienced one-tick users and a lot of people who are new to the platform. So I'm going to keep it pretty high level in this webinar. I'll explain what problems the surveillance solution solves and how it relates to the rest of the one-tick platform so that you'll end up with a good idea of whether the solution is likely to fit your use case. So I'll start with just a little context to show what problems we're trying to address here and focus on the specific market activities the solution can monitor. Then I'll give a quick overview of the ways you can deploy it to your firm, and I'll devote the rest of the time to a demonstration and then answer any questions that you have. Here's one proxy that sort of encapsulates what's going on with respect to regulatory scrutiny and market surveillance. These four charts illustrate the sea change that has taken place in the regulatory environment over the past 9 or 10 years. Since the financial crisis, since Dodd-Frank, since the flash crash, since the advent of MiFID and MAD in Europe, more regulatory attention is being felt in many ways, one of which is an increasing number of regulatory actions, those are the blue lines in the charts, and dramatically increased financial penalties. Those are the orange lines. You can see that it's kind of like a 4-to-1 increase over the period in financial penalties levied by the SEC. CFTC enforcements and penalties are way up. In the UK, the FCA, Financial Conduct Authority, has increased its penalties from basically zero to an expected well north of £1 billion in penalties levied by the end of this year. Even FINRA in the US is getting in on the action and increasing its fines under pressure from the SEC to increase its fines. And the SEC is under pressure from the political world, for example, Senator Warren, to increase the fines that it's levying still farther. What you don't see in the numbers is what's going on under the hood. So 2 categories of big changes. The regulator's legal toolkit is much more effective than it was. Under Rule 10b-5, the SEC goes after attempted use of any manipulative or deceptive contrivance. For the CFTC, reckless misconduct is replacing proof of intent. Easier to prove reckless misconduct in a court case. The Securities Exchange Act of 1934 was amended to add aiding and abetting. Whistleblower programs, the SEC and CFTC have both launched those programs. Compensation clawback, more aggressive than under Sarbanes-Oxley. Failure to supervise, leading to failure to do surveillance, which is now actually being used in cases. The regulator's technical toolkit is better now as well. The SEC has their MIDAS system with all public market data, CAT, which will have non-public data as well, is coming. They've talked about their use of machine learning techniques to detect fraud and to detect market manipulation. The CFTC is watching for correlation, detecting manipulation through correlation events, not just looking at single instruments. I could talk about the market structure stuff all day, but here's what the rule changes and upgraded regulatory toolkit imply for the regulated entity. Business risk, in short. In fact, existential risk. That's how big the fines are getting. And obviously, there's a reputational hit as well. One appropriate response is inoculation, a vaccine for the risk. And the compliance vaccine is trade surveillance. Not surprisingly, market participants are upgrading their surveillance systems. When we set out to design a smarter surveillance solution, we talked to customers and to legal and compliance experts about best practices. And this is what we found. On the left side of this chart, we have the old school way of doing things. And on the right side, current best practice. Market participants are moving from homegrown systems developed by in-house IT to third-party managed deployments or software as a service. Third-party, especially because through third-party products, market participants gain access to kind of consensus view on best practice, which you might not have if you're using your own in-house development. The old T+1 batch surveillance report is being replaced by intraday alerts and even true CEP or real-time mode monitors, and the order book microscope, which I'll talk about a little more later. The old simple rules are being replaced by advanced analytics. The old trades-based approach is now being replaced by approaches that examine orders and cancels orders even if not executed for probable intent. SIP market data as the reference standard is being replaced by direct exchange feeds and full depth of book views in surveillance systems. Market by market, single instrument views, now cross-market, cross-product, correlated instruments. And a long change cycle is no longer tolerable. It can't take 6 months to add a new alert type or to modify an alert. Compliance officers and trading supervisors are expecting to be able to deploy new alerts within a day or so, and experiment with them intraday. These best practices are what we've tried to incorporate into the one-tick surveillance solution. What products and markets does the solution apply to? Here's a sort of heat map of the financial world with regulated markets across the top and regulated entities or types of a regulated entity down the side. I warn you, this is a very unscientific slide. I took crude counts of regulator actions by type of market and type of market participant and colored accordingly. So obviously the more red, the more activity. The little explosions relate to headline stories that I happen to recall, such as Bats messing up its own IPO here, and dark pool probes and fines, recent SEC and CFTC actions against market makers, a spoofing conviction, the Knight accident, spoofing probe related to the flash crash, GS options blow up, Forex fixed manipulation, the LIBOR scandal. Even asset managers are in the crosshairs. SAC Capital, for example, with its large insider trading fine. The dashed line shows the product areas and types of entity that the one-tick market surveillance solution is best suited for. It covers a pretty broad area, but it is a market or trade surveillance solution. It automatically examines the trader's order flow into the market in the context of market data. It does not currently handle surveillance of unstructured data, for example, emails or voice records or social media. Let's look at some of the standard surveillance alerts built into the one-tick surveillance solution. So spoofing is getting plenty of press. I was at the FIA show in Chicago last week, and the COSIA spoofing conviction came across the tape, and that got lots and lots of attention at the show and increased the attention. You could see the increase in attention and interest in some of the surveillance solution providers who were at the show. Spoofing is one of the fundamental manipulations in a way. It's an attempt to manipulate price or volume by placing orders without the intent to trade. There are quite a few variations of it. Post and flip, so layering is one. We bundle that in with spoofing. Post and flip is another. There was a recent, that's where the spoofer induces other participants to join his spoofing order and then cancels it and takes the joined side. There was a recent CFTC action related to this post and flip spoofing. The pre-open spoof, manipulate before the open and liquidate post-open. There was, again, an action related to that one. There were quite a few flavors of spoofing. Wash trades have been in the news recently, with several CME fines this month and last month. And quote stuffing. Quote stuffing refers to generating a lot of quoting, canceling activity with the intent to swamp or slow down, or even not with the intent, but just with the effect of swamping or slowing down other participants' view of or consumption of market data. Quote stuffing got a lot of press for a while, especially after Michael Lewis's book. It's still getting regulator attention, and market makers have to take a great deal of care because quote stuffing is difficult to distinguish from a high cancel to order ratio due to a jittering fair value or from a technology error. And one of the ways to avoid getting into trouble for completely unintended activities and behaviors of algorithms or of quoting systems is to continuously monitor your own order flow to make sure that surveillance is catching things before an outside regulator does. And we monitor for simpler things like high order to fill ratio, which is pretty much the same thing as quote stuffing, except the intent differs and the reasons for it will probably differ. Another group of alerts relates to potentially manipulative activities near the close. This is here marking or banging the close, moving a benchmark, large fixed orders. This is getting a lot of attention from regulators since the Forex manipulation scandal, which involved banging the close and fixed manipulation. We also have some alerts that are relevant to agency brokers who are managing accounts for others, such as possible intraday churning. The one-tick surveillance solution includes a number of alerts and monitoring tools designed to help with the market maker remain compliant with exchange market maker obligation rules. Compliance for continuous quoting, for example, monitoring and alerting on maximum quote width and quote size, and potential cross-instrument, cross-market manipulation. And we're getting a great deal of interest from market makers, quite a few of them in Chicago, who definitely feel the heightened regulatory scrutiny. So I'm going to talk a little bit about architecture and deployment and then jump to the demo. The solution is based on OneTick, a high-performance financial time series database and streaming query engine. In deployments today, it is handling real-time data from all major exchanges, sometimes simultaneously, including Opera and direct exchange feeds, and supporting analysis against hundreds of terabytes of historical data. It includes a large library of built-in analytical functions that can be used in streaming queries. And it is integrated with other analytics packages that are very popular ones such as R and MATLAB. Strategists can implement sophisticated queries using the system's default visual graph language and programming tools, or by writing in the language of their own choice, such as C++ or Java, Perl, Python, R, for example, through the integration layer. Let me say a little bit about how you deploy the solution to your firm, and then we'll get to the demo. So the default way, and what we find is the simplest and most cost-effective way for customers, is fully hosted and managed by OneMarketData. And here, the engines and the market data are hosted by OneMarketData. We have our own market data. We collect market data. We have vendor data as well. But the surveillance dashboards are running at the customer's site. We can send alerts in the form of emails from a hosted instance, but the customer can also monitor the system either intraday or end of day using surveillance dashboards. What we show here are trading supervision and compliance using monitoring tools. We provide order flow going into the customer's order management system, being sent to OneMarketData, being stored securely in our historical databases, the alerts capture, the alerts mechanism running, and generating alerts which feed back to monitors at the customer site. Customer strategists and developers can use the visual development tool to develop new alerts or modify their own alerts and replace them in the system. We can also, of course, some customers are interested in deploying the system at their site. The system is basically the same except running at the customer site. Typically, the cases where this may make sense would be a market maker who is very concerned to use their own market data, the market data that they are trading off of. They want to use that market data in their surveillance solution and then from that perspective, it would make sense to have everything locally hosted at the customer's site. To summarize, I've tried to position the solution in terms of the markets and types of participants it's designed to support, everything from stocks to FX, exchanges to small agency brokers, and in terms of its capabilities, intraday alerts, and add your own alerts, and deployment options, hosted and fully managed by OneMarketData or hosted at the customer site. This dashboard, the dashboard you're seeing here, was designed with trading supervision and compliance officers in mind. And there's a little collapsed format of this, kind of like one of those little radio things that you get in an iPad app or on your laptop that collapses down, and lets you pick the radio station of your choice. We have a little one that will display just new alerts as they arrive, and then you can expand it out and you get this full dashboard. For the compliance officer, the idea is to organize everything into one convenient dashboard rather than have a confusing set of tools. Alerts are summarized along the top, in the top third. So you can look at the history of alerts and you can drill down into alerts and filter. In the center panel, we have a list of alerts after filtering and details of specific alerts. And in the bottom panel is devoted to seeing and examining the alert in the context of market data. So let's have a look at the individual pieces. So you can select a date range up here. I've chosen a day just to simplify this, 1 day of data just to simplify this for the demo. We can look at aggregate statistics about different kinds of alerts, the number of orders placed, the fill ratio, just as two examples of statistics that you can look at, but it's very easy to plug in new statistics that you may be interested in that are aggregate statistics across types of alerts. We can look at alert types of different, the frequency of alerts of different types. We can look at them across customers. And over here in the upper left-hand corner, what we can do is drill down in different ways into what's going on. So for example, I could look at alerts by account, and then it'll show me the accounts, and I could then organize them or group them by status within an account, if that's the way you want to find a specific alert. Let me regroup this in an easy to read way. I'm going to look at it by alert type, and then I'm going to look at it by security, for example. And so we'll be able to see alerts by individual securities. What I see here is that we have 53 alerts. It seems like a reasonably large number of alerts under quote stuffing. So let's look at what's going on there. So what I've done now is I've effectively filtered. I've selected a particular group, and now I can filter the rest of the display. You can see that down here under the alerts list, it is updated to look just at the quote stuffing instances. I can filter further by looking at a specific symbol. So here we have MYL. I can look at CMG over here. Let's go back to MYL and see what's going on there. We have a number of alerts for it. So if I look down, I can see the alert by time. If I hover over things, I get the details of individual alerts. I can select a single alert, and then what we see is that the whole monitor updates, and we have an alert description in the center, and we have the details of this specific alert over here. If I select another alert, this will all update. So let me go back to this one. And what we have here are the specific orders that led to this instance of the alert. And then down here in the market timeline, I have a view of the alert in the context of market data. And over here, I have a market snapshot that shows prices and where the customer's orders were layered with respect to this particular alert. I'm going to try to find one that maybe is a little bit more interesting. Let's look down here. We have one here at 1029 in CMG. Select that one. This is a quote stuffing alert. Now here we have the specific orders that led to it. It looks like there's a lot of them. So what I can do is expand that list. And what we can see is is what exactly the orders that triggered this particular alert is within a very short period of time. It looks like it was all within 1 second. We had a huge number of cancels. You can sort it by timestamp. We can see, yes, indeed, it's all within 1 second. And they're clumped right around here. I can drill into this and get as close as I want. This is what I was referring to as a market microscope. I can also look at the individual events that was happening here by moving the slider along. I can back off, drill in closer. If I want to center it, I can center it, say, over the 8 minutes where this, now right at the center, we have what triggered the alert. There's still a lot of detail here, so let's expand this out, get it to fill the whole screen. We can drill right into what exactly was happening at this specific instance, and we can see that the spread was pretty wide, and we can see the little circles are cancels. We can see that a lot of previously layered orders were canceled right here. What is going on? And then a lot of new orders were placed. Now, the spread is pretty wide here, so you can see this 20 cents between the bid and the offer. This is obviously a thinly traded name, and it looks like the trader is layering orders, a huge number of, a lot of orders. You know, there could be more than one thing going on here. Who knows? This could be, you know, there could be some other kind of manipulation going on here, or there could be some quoting malfunction. It happens that the particular alert that triggered first was quote stuffing because of the very high rate of cancels that we saw here and lack of any apparent economic activity going on. There's no trading happening there. Over here, I can look at exactly how the strategy or the quoter was layering orders around the time of the event, and I can look backwards in time and I can look forward in time, and I can see exactly how the bid size and the offer size moved. So what we have here is, you know, the ability for the surveillance officer to drill down, look at the alert in context, and decide if more needs to be done. I've got here a display of some statistics about this particular alert, kind of a summary view over here, and this will differ depending on the specific type of alert I'm looking for. I can then go into the workflow, the surveillance workflow related to this alert. I can see that this alert has already been acknowledged. Somebody has looked at this before, but maybe now I've done a little bit more investigation. I've walked over and perhaps I've talked to a trading supervisor or somebody who knows about the quoting behavior here. I can say, look, I'm now investigating this alert. I'm going to assign it to Arthur to drill into it deeper. Maybe I can make a comment here, and then I'll save it. And that will update. Now we can see that the alert has been acknowledged. It's under investigation. Close that out. And we can see here in the display that the status is updated to under investigation. So that very briefly is a walkthrough of the process. Very, very briefly, because you know I want to leave time to take some questions as well. I'm going to show you how this would look if I were a strategist who was updating or editing this alert. You know, I would go into my alert editor console here. There's a quote stuffing alert. Maybe I want to make some changes to it. Let's bring it up and show how it looks in the visual development environment. And here I can see different pieces of effectively code. This is doing some computation on the order data that's flowing in. Here we're joining order data with market data in order to see the alert in context. And then we're going down and doing some filters and applying some rules that determine whether or not this is indeed a quote stuffing alert. So that's how it would look, and I can move these around, and I can change these and look at how these are parameterized, and then I can actually run it experimentally and see if I made some changes how that would look, and then save the modified alert back into the system so that we can adjust the way we're doing surveillance. But all the data, all the alerts it has already collected are archivally stored, and any new activity or any rerun alert is not going to delete old data. It's not going to change it. It's just going to add new data to that alert. I want to just summarize, recap what I've gone over. So OneTick, a smarter surveillance solution, we think it is, fully managed and hosted by OneMarketData as in a software as a service mode, but we can also deploy it at the customer site. It has a library of standard alert types, pretty comprehensive one, plus the flexibility to add your own. It supports intraday alerting, order book microscope, advanced analytics. You can examine order and cancel activity, not just trades. We support cross-market, cross-product, and correlation-based alerts. You can design new alert types with an easy-to-use visual language. So I'm going to turn this over to Hugh now and take any questions that you might have.
While you're talking about alerts, you spent quite a bit of time on that. You mentioned a few of these, but how many does the system support?
So right now, depending on how you count them, the system has between 15 and 20 separate alert types. And I like this question because obviously being responsible for the product and the development of the product, I also look at what else is out there in the market, and I see people claiming that they have 100 alerts or 200 different alert types. But if you look at what activities people are doing surveillance for, you really find that there are a relatively small number of fundamentally inappropriate activities that potentially disrupt the market. But there are many flavors of those activities. And so if you go out there and you find a system that's offering 200 alert types, very likely that's the same 15 or 20 fundamental activities that but with a lot of different flavors of variations on them. So take spoofing, for example. There's layering, there's spoofing, there's pre-open spoofing, there's post and flip. Those are just 4 of the different flavors, but there are quite a few others. And people can call them separate alert types, or you can call them one parameterized alert type. And we tend to bundle things a little bit more, and we provide the end user with the flexibility to parameterize the alert so that it makes sense in the context of your particular trading activity. I hope I've answered that question.
Okay, yeah, I think so. While we're talking about alerts, a question came in, does the system support alerting in real time?
Well, yes, it does. It supports intraday alerting, and it supports intraday at a very high resolution. You can have the alert set to recalculate whether or not there are alerts, let's say every minute or even every second. Now, real time for some people means event-driven, CEP mode. The underlying infrastructure does support CEP mode, and we can actually deploy CEP mode true real-time alerts, but they don't always make sense. If you actually study how alerts ought to be generated from the market microstructure perspective, some of them make a lot more sense if you actually accumulate a little bit of market data and trades data, make sure that all the timestamps are solid, that you've caught any what can happen quite quickly is you can get market corrections from the market centers very quickly afterwards, and you want to incorporate them into your alert. So typically the way we run these is we accumulate a little bit of market data, it could be a minute, of market and orders data. When it's all stable, then we'll calculate whether or not an alert actually took place. That makes a lot of sense because once you put an alert in the database, then in many financial firms, that means that a compliance officer then has to investigate that alert. So you don't want to be doing that based on unstable data. For that reason, some of our customers prefer to run the system only at night after all market data corrections are in, so that they're generating the minimum number of spurious alerts. Now, when it comes to market makers, though, the story is a little bit different. When it comes to monitoring things like your on-quote, your obligation to exchanges, for example, your spread obligation, or your percentage of time on or near the quote, the inside quote obligations. Some of those you want to see as real-time monitors. They don't actually generate alerts, but what you want to see is an actual CEP mode real-time monitor to make sure that you are fulfilling your obligations to the exchange. So again, I hope I've answered that question.
Yeah, good. Here's one. How does OneTick get the client data for these alerts? Does the client need to send it in directly, or can you source it from the drop copy?
We can do both. So we have cases where the client is sending their own orders. And I assume you're talking about the client's orders and trades data, where the client is sending. Actually, we have cases where the client is actually collecting that in one market data databases because the client is using OneTick for other purposes at the firm. We have other clients who will put the orders and trades data in their own format and transmit that to us. We have clients who are using an order management system of their own design, or perhaps one of the commercial ones out there, an order and execution management system, and we will interface to that. And we've interfaced to a number of them already, and we're willing to work with the client and interface to their in-house system if it's one that we haven't encountered before, and get the data that way. So there are numerous ways we can get order and execution data into a fully hosted instance. And of course, there is the option of hosting the surveillance solution at the customer site and interfacing to their data that way. Now, if you're talking about market data, there are two ways. If it's fully hosted by us, then we use our own collected high resolution, high integrity market data and our own reference data as the data against which we run the alert queries. If it's hosted at the customer site, then we'll use the customer's own collected market data. So that's it for that question.
Okay. Follow-up came in from that. Which third-party OMS systems have you worked with?
Great question. I would love, Bloomberg is one example. I would love to give you a list. I don't have it on the top of my head, but if you, if we can identify you and we have your email, we were happy to send that list to you.
Okay, great. So I'll ask that questioner to please send an email to request that information. Another question: talk about the infrastructure you need to run all this. What is required in the client facility to make all this work?
So in the client facility means you're talking about a deployment. We have the size of that deployment, in other words, the number of servers you'll need and their configuration will depend a lot on the amount of market data that we're going to be looking at. It doesn't depend very much on the customer's order data. That's always much smaller than the market data. But we have like a typical base deployment, a smaller deployment would consist of 2 servers. You always want 2, one for backup, each with as little as 4 cores. That would be a typical one and a useful one. But we have deployments that scale to a much larger size because the customer is looking at a lot more market data. Maybe they're an options market maker and they're looking at the full Opera feed and they're looking at direct exchange feeds, and then they're cross-referencing that with the underlying equities data feeds using direct market data feeds again. That's a lot of market data. The platform's footprint would be bigger in that case. What we typically do, there's no single answer to the question, rather than throwing out an answer, what we typically do is we sit down with the client, we go through, well, what are your needs? What's your market data? What kind of guarantees do you want in terms of, collecting every tick, that sort of thing? Are you collecting live market data, or are you just interested in surveillance and you just want data that you've already collected some other way and you want to run it overnight? Answer those questions, we'll come up with a profile of the system that will serve your needs.
Okay, very good. So how does this relate to cloud-based deployments and so forth? There's a question about running this on our own servers, but what about running it in the cloud? Is that possible? And what about security?
Yeah, so great question. So cloud means different things to different people. Sometimes it means, Amazon AWS. Sometimes it just means any off-site sort of vendor-hosted system. In our case, when it comes to surveillance, it means more the latter. So we run and operate and have built our own cloud, which is especially designed for very efficiently hosting, collecting, running analytics on huge volumes of market data. We also, by the way, do use Amazon AWS, so we do have a true cloud-based service. But for surveillance, especially for when it involves us receiving and databasing and doing analytics on the customer's own highly confidential order and execution data, then we keep it in our own secure cloud environment. And we have a number of layers of security. So transmission can be encrypted and secure. Connections to the customer's dashboard can be encrypted and secure, and even the customer's data in databases, it can be stored in encrypted databases. So it's kind of like a fully multi-layer security environment. We also have, authentication mechanisms. We support several authentication mechanisms and permissioning systems within the system. So again, that's something that we would sit down and talk with the customer about and set it up in a way that serves their needs so that, for example, we can control the visibility. If we're supporting surveillance across multiple desks, we can make sure that visibility is managed in such a way that people at one desk can't see data belonging to another desk. If there's a surveillance officer who should be able to see all of the data, we can permission it so that that visibility is permitted as well. We're pretty flexible that way because we've been in the business. Surveillance is relatively new for us, but market data collection and you allowing other people to build systems like surveillance on top of our platform, that's something we've been doing for 10 years. And so over that time, we've developed quite a comprehensive suite of secure mechanisms for handling customer data.
Okay, excellent. What about which markets are we talking about? What markets does this cover? And specifically, what about the U.S. and the EU in particular?
So it would probably be easier to answer that question by giving you a list of market centers we don't cover. We do have pretty comprehensive coverage of certainly of all the major U.S. markets and European market centers and their data formats. And we're currently collecting at multiple customer sites. We're currently collecting market data from most of them. We've got market data from most of them also archived and collected in our own cloud product, where we have a huge amount of market data from multiple market centers, which we offer to sell, and we offer analytics on top of through our cloud product. And we leverage that for our surveillance product as well when we're hosting it ourselves.
Right.
I hope I've answered the question. If you do want a very specific list, I don't have it again on the top of my head, but as I say, it'd be easier to actually find the market centers we don't support yet because we support most of them.
Okay, great. And what about futures markets? Yes.
So we have implemented surveillance alerts on futures data from multiple market centers, the CME, ICE, we've pretty much all the futures complexes, although what we've noticed is that there's a great deal of attention and interest in the rates complex at the moment. Treasuries. Basically a lot of the work we've been doing and a lot of the interest that we've been seeing from market makers is in Treasury futures, but we definitely support them.
Okay, great. And this is a pretty specific question, but it sounds like an interesting one. With regard to futures, are you able to identify when the settlement price is determined on a product-by-product basis? That is, the settlement price of the E-mini futures is determined during a 30-second window between 4:14:30 and 4:15.
That is a great question, very specific one. I know for sure that we have done that kind of thing. I don't know specifically for that particular future, but when it comes to other alert types like close manipulation, fix manipulation, we certainly have implemented and run alerts that look at a window of time and calculate a closing price based on that window of time. Again, happy to get back to you with respect to that particular future in that complex, but that is something that we definitely do.
Okay, all right, super. What about advanced analytics? What exactly are you talking about there? What do you mean, and how would you apply advanced analytics to the surveillance problem?
So that's a good question. Kind of a funny one because there's no single answer to that. Really, what we find is that there's a great variety of things that our customers are doing with the platform. We've come up with alerts that we think address the basic, our standard alerts address the basic scenarios that are getting most regulatory scrutiny and attention right now. I don't know if you call them advanced or not, although spoofing in all its flavors does get pretty complex. But what we find is that our customers are doing even more innovative things on top of it. They're coming up with alerts and they're coming up with analytics that will look at cross-market correlations, for example. Let's say you're trading energy complex on the CME and you're trading it on ICE. You want to make sure that in-house, you're not doing something that might look like spoofing in one part of the complex and then trading in the other, manipulating on one market center and trading the other. And we don't even know all of the techniques that people are using or are interested in to detect that kind of behavior. What we try to do is make it possible in multiple ways. We have our own fairly advanced analytics that are built into the graphic query language, and we interface to much more stats-centric systems or platforms like R and MATLAB. And we allow the integration of machine learning toolkits, and people are using that too.
Excellent. Okay, I think that covers the questions we have, and we're going in about 45 minutes into the sessions, and I think everybody has a lot of work to get ahead of to do for the rest of the day, so we're going to call a halt to it right here. If you have questions that we were not able to get to, please email us at info@onetick.com, or you can call one of our offices. We have numbers there in New York, London, and Tokyo displayed. You can also check us out on the web at onetick.com. We have a lot of information on the website that you can download, and some videos and so forth that may be helpful to you as well. Thanks very much, Dermot, for a great presentation, and thanks to everyone for attending.
And thank you, Hugh, and from me too. Thanks to everyone who took the time to attend.
Okay, very good. Thank you all.
Bye-bye.